Hi, Peter. How are you?
How you doing?
Good. All right. So I know you have some time constraints. I want to get right to it. During our discussions in the past, you always felt that Europe was going to be the epicenter of the next recession or crisis. And I went to your site, and you're using the metaphor of a song, I believe, for Draghi. Video killed the radio star. Is Draghi the radio star?
No, actually, it was. If you go further down in my note, it was yesterday. It was actually referring to Japan, where not one 10-year JGB bond traded the entire day. So I basically said the Bank of Japan has killed the Japanese bond market.
Repercussions?
Now you can also say that Draghi has killed the European bond market as well. And central banks have, generally speaking, killed the free market, if you want to take it another step further.
Okay. All right. So Draghi, we had the ECB last week. I know you've been bullish euro, bearish dollar, and Draghi tried to talk it down. It's under a little pressure right now. Do you think that Draghi's what you were looking for when we talked months earlier, that Draghi's on course for your expectations?
Yeah, he's on course for his extraordinarily dovish way of exiting their accommodation. So yes, he's on course for that. Yes, the euro continued to trade well, but at the same time, the dollar continues to trade poorly against many other currencies. I mean, just look at Friday's action in the dollar. I mean, if you had to script a perfect setup for a rally in the dollar, strong payroll number, higher interest rates, the possibility of a fourth hike this year instead of 3, and the dollar could not get out of its own way. So yes, it's euro strength, but it's also dollar weakness persistently against a lot of currencies.
Okay, so I want to ask you this, even though I know you're not going to agree with it. You know, I do a lot of intelligence gathering, Peter, and I know a lot of very sharp market tacticians that are looking for euro 126, 127, and then they think there's going to be a big correction that could take it all the way back down towards 116. What fundamentally could drive the euro lower to those levels and possibly peak up here? Could it be trade war ramifications?
It's a good question. I mean, let's before I answer what would weaken it, I think a main factor in what has strengthened it is the European recovery, the trade surplus, with the contrary trade deficit the U.S. has. I think if the U.S. can shrink their trade deficit, well, that may help dollar flows. If the European bond market blows up because Draghi post accommodation, well, that potentially could weaken the euro. But on the other hand, maybe high rates helps the euro. So I think, well, I'll say this: it's maybe potentially the Fed that starts to get ahead of the curve in terms of policy, rather than this dovish gradual pace of rate hikes. Maybe that's what is needed to weaken the euro.
Okay, yeah, I knew you'd come up with a fundamental reason. And why don't we talk a little bit about Powell? I've read some of his language. Doesn't sound like he would mind if there was a 20% correction in equities. I think a lot of people still believe there's a Fed put out there. What do you think about Powell and his philosophy about risk assets?
Well, there's no question that there's a Fed put out there. It's just a question of where is the strike price. The reason why there's a Fed put is because of the Greenspan, Bernanke, Yellen model of having creating this asset price dependent economy. So if asset prices fall, that threatens growth. Therefore, there is a Fed put of some sort. Now, with Powell, I think that strike price is much further out of the money than it was with Bernanke and Yellen. And whether it's 20% or 30%, we'll have to see. But there's in this new world post-Greenspan and monetary policy, there's always a Fed put, just a matter of where it's placed.
Do you think they came in at the 200-day moving average that we had in February, where it tagged it twice and recovered?
No, I don't think they're that smart.
Okay. Maybe it was Carl Icahn, like after the Trump election. So let me ask
you this. A lot of machines are staring at the same lines that we all do. Everyone's looking at these moving averages, and a lot of it's trading off. And going back the last couple of years, it's paid to buy that 200-day moving average. It's the question is what happens when you start to test it a second or a third time. That's the test, not necessarily the first time.
Okay, so we've made new highs in NASDAQ, Peter, but the other averages haven't followed suit. I'm thinking that you believe that we will retest those lows and take them out. The question is, though, can the S&Ps make new highs before that happens, or are we still in a correction from those lows? What's your take?
Well, we've seen the NASDAQ certainly recover, but half of the NASDAQ 100 rally has been 5 stocks.
Yeah.
And all the all the big cap tech. If you look at, broadly speaking, the number of New York Stock Exchange stocks trading above their 200-day moving average, we've only got basically about half back of what we lost. So, there's a different complexion to this market post-January when rates have now risen above to multi-year highs. It's clear that any tape watcher can see that there's a change in tone here. And it's not just the rise in rates, but behind the scenes, the Fed balance sheet is getting smaller. And in 2 weeks, they're going to go from a pace of $20 billion a month to $30 billion a month, from $60 billion a quarter to $90 billion a quarter. It was only $30 billion a quarter in Q4. And I'm of the belief, just as quantitative easing created a lot of excitement and enthusiasm, nebulence for risk assets, I'm also of the belief that quantitative tightening will do the opposite. Now, whether it is immediately symmetrical, it is not, because the pace of quantitative tightening is only increasing over time. But to think that there's a free lunch here, I think is somewhat delusional in terms of the impact of not just the rate hikes, but a smaller Fed balance sheet and therefore a reduction of liquidity. Then as the months go on, you get closer to the end of QE in Europe, as they will likely end it by year end, but dramatically taper again come October 1st. So there is this liquidity flow that is turning into a drip. And when it comes to multiples and what you want to pay for a stock, that is a big deal. So you can do all the economic analysis as you want. You can run all the earnings per share estimates you want. The liquidity and the interest rate environment is changing, and people have to be cognizant of that.
Were you surprised that the VIX retraced all the way back from 50? It looks like we have a different volatility regime. I don't think we're going to see the 10s anymore, or the 11s.
I think we may not see a 9 handle for
the rest of our lives.
Next cycle, whenever that might be.
Okay. All right. And do you think that what happened, that there's still some damage out there in the markets from people that have been picking up pennies off the sidewalk before the steamroller came, that were shorting or had writing strategies on selling volatility, or do you think that's all been cleaned up?
I mean, I'm sure that the trade will, just as anybody will short anything, just as they buy anything, there'll always be someone who's going to be short the VIX or short volatility. I think it just got to a level of extremity that obviously had the sharp snapback. I think what was most interesting about what happened is it was only a very modest increase in interest rates that blew up an entire trade. I mean, the 10-year yield went from 240 to 270, and you had this massive trade unwind. And I think that should be a message to everybody of how sensitive markets and the economy are to modest changes in interest rates. And people can say, oh, well, yeah, interest rates are up, but they're still very low. But look what a 30 basis point move in the 10-year did to a potentially a $1 trillion plus trade. It evaporated it in 2 days. So okay. I think that should have been sort of a canary in the sense of people should be reevaluating their risk profile and not assume that the next 2 years are going to be the same as the last 2 years.
Okay, and I have the yield chart up there, Peter, and it looks like we're getting not much relief, and maybe we could even see 275 on the 10-year, but the trend looks like it's gaining momentum and force. And where do you think the next tripwire would be? Around 3.25, where the market would wake up and pay attention, or all we need to do is rally to new highs in yields, and that's going to pressure the market? And
no,
what are you looking for? What are you looking?
Well, it's going to be 3. It's going to be 3%, not because 3% is a round number, but because we got to 303 on December 31st, 2013. We got to 3% in September 2013, and we weren't at 3% before then until 2011. So just because we got there twice in 2013 on the taper tantrum and then fell back, that's the next real level of importance. Again, not because it's a round number, but because they tried to get above that twice in 2013 in the middle of the year, the end of that year, and then failed. You get above that, then you're talking 7-year highs in 10-year bond yields. You're already at 9.5-year highs in 2-year yields. So we can look at the 10-year, but the short end certainly has adjusted mightily as well.
So we had a little brief period of yields beginning to, the yield curve was changing from flattening to going the other way. Seems to be flattening again. Do you have a view on what the curve is going to do in here?
Certainly the trend has been narrower. I think a lot of that will have to depend on the Fed. If the Fed still stays with this very gradual pace and they still stay at 3, even if inflation numbers start to tick higher, which I expect them to do, then I'll actually expect some steepening because I think that the long end will tighten for them. If for whatever reason Powell says, you know what, 3 is way too gradual, let's do 4, and even 4 is gradual considering that Greenspan was doing it 8 times a year in the mid-2000s, well, then maybe the curve can flatten again. So I think it's really a question of whether Powell is going to be Yellen 2.0, or he'll try to get ahead of the curve to try to contain the rise in long-term interest rates by raising a 4th time this year.
Well, lawyers don't do anything without a retainer, so maybe you'll want put a few hikes in the bank. I wanted to turn to gold. I know you're a proponent of it as being at least part of people's portfolio. I was taught that shares should lead the way of the underlying commodity. And, gold looks great, Peter, but when I look at some type of gold shares, they're underperforming fairly dramatically, except for the silver shares. And I'm wondering if there's some type of market tell. So here's, Coeur d'Alene and here's Hecla. But then if you go and you take a look at some of the gold shares like Imana, they look ugly compared to the gold. So is there the reason for that just being the debt that the miners have on the books, or is this a market tell to be patient about buying gold until the shares look better? What do you think?
I think it's going to be the price of gold and silver that's going to lead the way. I mean, XAU, the gold and silver index, I mean, it's back to where it was in 2003 when the gold price of gold was dramatically lower. So the bear market has been so vicious in this sector that I don't see it getting reignited until the price of gold and silver maintains current levels and then goes higher. I mean, there's no question that even at current levels, I expect miner earnings to improve dramatically over the next couple of quarters. Gold prices are up 30% over the past couple of years. So earnings from a fundamental standpoint are getting better for this group. I just don't think from a psychological standpoint, people are really believers. And I think it's going to need to be a further rise in the metals prices, with gold maybe above 1350, convincingly, approaching 1400, and silver, needs to get out of its own way. I think that needs to drive the way. Now, listen, it would be encouraging if the miners start to dig in and people start to appreciate the earnings power that they have, even at current prices. But I just think people have just gotten so beat up that they rather see a convincing rise in the metals before they buy the stocks.
All right. Well, I have to ask you, do you think it's also a possibility of people looking at cryptos as an alternative source for their safe haven money, even though it's not a safe haven at all? And what's your view on cryptos in here?
I'm sure that has a factor in it, but gold's a global currency, and if you're in Germany and you're in China and you're in Japan and you see what your central banks are doing, you're certainly more inclined to be buying gold than Bitcoin. Now, granted, Bitcoin in Japan is big, so I'm not taking away from that. I'm sure there's an influence, but I think the bull case in gold and silver may be only temporarily altered by people's views to cryptos than anything else. I am all for the concept of what spawned these cryptos, and particularly Bitcoin, and that let's have a finite currency limited in supply that's not dictated by central banks, and maybe even make it a form of exchange and payment. But the price of Bitcoin, and the price of all these other cryptos, I have no idea where they should be. So I understand the technology. I appreciate it. I appreciate the concept. And maybe we will have some form of electronic payments that are coin driven. But whether Bitcoin is 8,600 or 50,000 or $5, I think it can go to any of those prices and no one would be surprised.
Yeah, right. How can you use it as a medium of exchange if you're in the grocery store and your Bitcoin is worth 20%, 30% less in an hour, and you go to pay for your groceries?
You can imagine the races around that supermarket. It's everyone's cart rushing to the cashier.
So, Peter, I just want to wrap it with perhaps I could show your website, and people should follow you. And I also saw one thing on King World. You get published there quite a bit. It seems like you're looking for the recession to begin in full swing 2019, that this is kind of a transition year to get from growth, even though we're getting better GDP numbers, to a recession. Is 2019 when you think a lot of the things you've been telling people for a few years begin to manifest in full force?
Well, rather than putting a year on it, I want people to understand what will drive the next recession. There's this belief that the economy turns down and then that leads to a bear market in stocks. But the last two recessions were driven by declines in asset prices. Exactly. Technology stocks fell. It led to a collapse in capital spending. Obviously, house prices fell, led to a collapse in bank balance sheets. It will be another decline in asset prices that leads to the next recession. This decline of asset prices, I believe, will be driven by higher interest rates, monetary tightening that leads to a fall in the equity market, and then that leads to the next recession. So when that happens, I don't know. I think the pieces are in place, again, because monetary tightening is intensifying as the year progresses, and that markets are clearly already reacting. I mean, we saw the first 10% correction in years because of a rise in interest rates. So just determining the question of recession, focus on asset prices, focus on interest rates, because that will drive the next recession. So,
so it's a bond market that's going to wag the dog, higher yield.
Yes,
so the asset class that most likely is the first to cave and cause problems can be things like high yield debt, things like that.
Right.
Spreads increasing, so those are the signs, correct?
Correct. And keep your eye on 3-month LIBOR, which is now essentially doubled over the past year.
Yeah, so that doesn't make it any easier to trim our budget deficit. Any comment, or you just want to avoid what's happening politically, and then I'll let you go?
Well, the higher interest expense is going to be a main driver of the U.S. government finances. I mean, budget deficits are approaching $1 trillion.
Right.
And in bond bull markets, that doesn't really matter. But if you believe, as I do, that we're no longer in a bond bull market, and that ended in the summer of 2016 after Brexit, well, the bond market's becoming more sensitive to major increase in supply. I mean, the 2-year note yield today is hitting a fresh 9.5-year high at 2.29%. Granted, that comes after the hotter than expected PPI and around 2% CPI that we saw yesterday, but also a lot of it is the enormous amount of supply that the market has to absorb in the short end because of these exploding debts and deficits. So now, all of a sudden, I believe they do matter. And again, that will eventually lead to a crimp in activity. The U.S. economy, U.S. markets have been addicted to near zero interest rates and all this quantitative easing, and they're going to be very sensitive, as I said earlier, to changes in interest rates that are moving higher.
Thank you so much, Peter. I'm showing your website. The best way to follow Peter is to subscribe to his insightful analysis. I know that every time I talk to him, he reinforces some of the views I have and also gives me pause, which probably saves me money from making mistakes. So Peter, thank you again for joining us. Good hunting in the next few months, and we'll get back together in the summer and see where
you are. I just want to, yeah, and just alert your listeners also that I have a new position. I'm no longer with Larry Lindsay, the Chief Investment Officer for Bleakley Advisory Group, which is a money management firm. So a lot of the things that I talk about, my money is where my mouth is. Okay, so you're now an RIA? Yes. Okay. All right, so minimum accounts that you'll take, Peter? It's open to negotiation. So anybody's interested, they can always check out the website and Google me, and we can always chat. Okay, Peter. Thanks, Dale. Peter, there you go. So besides subscribing, if you want a conservative guy who's aware that shoes can drop and there is a thing called gravity, you could have your money managed with Peter. Thanks for your time again, my trading warrior brother. Thanks, Dale. Be good. Okay, bye-bye. Everyone, that's Peter Boockvar. And I'd like to thank everyone for their attention today. Good hunting the rest of the day. Tomorrow's a terrific Thursday. I'll see everyone then. Remember, don't just count your pips, count your blessings. Good hunting the rest of the day. Don't forget to vote and pretend you're Nostradamus for a few minutes on your forecast for where the euro's going to be. I forgot the other pair. Peter's Twitter is @P, the initial P, Boockvar, BOOCKVAR. Okay, guys. See you tomorrow. You're very welcome. Adios. Thanks again, Peter.